All right, next topic. Jeremy Grantham says that this bubble that we've had over the past 2 years, where the Fed pumped $7 trillion of liquidity to save us from a pandemic, is the worst one of them all. He says it's worse than 2001. He says NFTs, crypto, all these speculative assets have led to inflated prices in growth tech. Now we're seeing that come down. Now, granted, Jeremy Grantham is a little bit of a perma bear, so he's been calling a crash for a very long time, but it seems like he might be right about this one after being wrong for the past 10 years. Justin, is this really the worst bubble of all time?
I disagree with the bubble. It's going to be worse than 2000, given peak to trough. Let's look at this. The S&P was down 44%, 45%. And it took a long time to get back because all those valuations from that bubble really ran up from 95 to 2000. So 5 years of over speculation about, quite prophetically, the biggest thing ever to happen to the human race, arguably, the internet. But they were all based on zero revenues and zero profits. Even Snapchat has EBITDA profits. Palantir has meaningful profits. A lot of these growth stocks that have come down have meaningful profits. So I think the valuations are there, and they're much more. They're much better today. And I think that eventually valuations act like as a mattress and as a floor. So I think we'll spring back much quicker. Now, we are less than halfway there. Well, that's fair. I actually think it's really interesting because valuations are at basically historical bottoms on price to earnings for small to mid caps. But in large caps, S&P 500 large caps, they still kind of we're only halfway there. So I think if he might be right that we're halfway to the bottom, but really focusing in on those large cap stocks, I do see a period of time where you see Microsoft and Amazon and all these really great companies going from 21 times EBITDA to 11 to 12 and then bottoming around there. That makes sense to me, but that doesn't seem like it would be worse than 2000 because 2000, I think, it took 7-8 years to get back to even. And then we had the financial crisis.
Tom, do you agree with Justin, or is this actually going to be worse than 2001?
So look, a lot of respect for Jeremy Grantham. He has forgotten things in his 83 years that we haven't learned yet. I'm sure of that. And he is a little bit of a pessimistic about the situation. Here's my 2 cents about this. Here's why I see this. Look, we all know that there's always a risk of a stock market crash. These crashes, they come in cycles. It happened before, it will happen again, and people will forget about it. And in 10 to 15 years, it will happen again. So it's kind of like the Matrix and Rio getting restarted every time. So it's nothing new. But throughout history, if you go back and you study the latest, let's say, 2 crashes, you see this common factor where people claiming, well, this time it's different, right? In the dot-com bubble, they said, well, this is different because the internet is going to change everything. Then in 2008, this was different because real estate is so safe, it cannot collapse, right? And now we're saying, well, look, the job market is so boiling hot, the economy is so good, this cannot crash, right? And as you know, at least in 2000, 2008, things, were not different. I mean, both arguments were wrong, and the crashes did happen, and they were extremely violent. Now, what we can learn, which is where I think I agree with Jeremy here, from these previous crashes, is there's always the same pattern, which is very high retail participation. That's the shoe shine example. How your shoe shine boy starts talking to you about his stock portfolio, right? So retail participation and a strong belief that things are different this time, combined with the spark being something happens that starts this whole shit show. Now, in this specific crisis, we had 3. We had the pandemic, we have inflation and QT, and now we have war in Ukraine, potentially war brewing up with China. So there's already 4 factors, 4 potential sparks to this, which can really make it one of the worst crashes we've ever seen. Now, I don't know if we get a crash or not. Jeremy Grantham doesn't know. Nobody on this panel knows. But if it happens, it has the potential to be a very violent crash, for sure.
Yeah.
Right.
I think one of the differences between now and then was you got a bunch of bankruptcies because you had a bunch of companies that couldn't raise money anymore and that were based off of zero revenue, zero profits, or very minimal, de minimis revenues and profits. I think it's just a little different now. I mean,
This time it's different. This time it's different.
well, no, I mean, well, it is different. It is different. I think. I'm not saying that.
Well, Tom, what would be your rebuttal to this argument that profits are
I'll tell
there?
you.
No,
I'm
not down-
actually agreeing with Justin here, by the way.
Go ahead, Tom.
What he's saying is that, like, if you go back to the .com bubble, pets.com, they were not. It was a fake business, right? Everything was just fake. Some of them were real, but it's like NFTs when it started off. A lot of it was like, what the fuck is going? It's just a greater fool theory. If you look at this stock market pullback, you have a lot of great companies that are performing on the business side, but the stock is in the toilet. I mean, the Palantir. Can we talk about Palantir? Killing it in every possible way, trading at the insanely low multiples, even though the business is doing better than ever. So
what does that mean? There isn't going to be a crash that bad because the company.
Well, this would be the counter argument to why a crash this time is either not going to happen or going to be more mild, soft landing. Like they like to call it. So Justin's argument is legitimate, and this is a counter argument to why Jeremy Grantham might be exaggerating.
And also another thing I want to call out is you're actually seeing some of these growth companies, these tech companies, authorize share buybacks. So which will provide
that's insane.
Relative
We've never had
floor.
buybacks in tech.
It's just a different. I mean, I know. I've studied bubbles. I'm generally trained to be pessimistic from Wall Street. I started out in leveraged finance, but I think it is a little different. So I'm not saying I still think that mega caps can come down another we may be only halfway there. So I kind of agree with him in that sense. But I think I'm hopeful that it won't be as long and drawn out and as severe.
Right. Well, if they do come down another 15%, it might be because of the market, or it might be because of Congress.